Welcome back to the Teaching Tax Flow podcast, everybody. Today on this spectacular topic that we are going to dive back into, because we've mentioned it many times before, on episode 163, we are going to look at MTR, marginal tax rate. And before we get into it in depth, we're going to take a brief moment and thank our episode sponsor.
This episode is sponsored by Wealth Builders Mortgage Group, powered by Movement Mortgage, one of the top mortgage teams in the nation and a powerhouse in the real estate investing world. With over $1.1 billion in closed mortgage volume and more than 3,000 investor deals under their belt, they don't just talk the talk, they walk it. Their team specializes in helping short-term and long-term rental investors scale smart with customized lending strategies. They offer all STR loan products, including second home, investment, non-QM, bank statement, asset-based, and HELOCs. They also offer all primary home loan products too. Whether you're just starting out or expanding an existing portfolio, their unique Path of 10 strategy is designed to help you move from a 9-to-5 job to financial independence. If you're looking for a lending partner who truly understands the investor mindset, visit wealthbuildersmortgagegroup.com and start building your roadmap today.
Hey, everybody, we are going to jump directly into this one because we do not want to muddy the waters and we do not want to overemphasize too much and annoy you what MTR is. So we're going to talk about what it is not, but I will give you three things that it absolutely does not stand for. So these are three things. It does not stand for making taxes reasonable. It sure as heck does not mean, oh, I'm missing the receipt, something you might tell your bookkeeper, drive them nuts. And it doesn't even mean you need more time requested. So we're going to talk about what it is. The best person to do that, Chris Pacuro, welcome back to the show, man. How's it going?
Thank you. It's going well. And marginal tax rate, or MTR, is one of the things that I really focus on, and it is so important not just for tax professionals, but for taxpayers to understand that this is the number one and really, in my mind, the only KPI, key performance indicator, when it comes to tax planning and strategy. Maybe the only other KPI is going to be someone's liquidity. And what marginal tax rate is it's different than tax brackets. Tax brackets are structured and confusing and actually deceiving. Marginal tax rate is the number one thing that you have to know about your tax situation. It stands for marginal tax rate. And what that means is, remember, in the teaching tax flow system, we have three laws. Tax agencies are your involuntary business partners, one of them. Tax flow and cash flow is another one. Marginal tax rate means, because we know that tax laws are written to encourage and discourage certain social, economic, environmental behavior. What it means is this: for every dollar of taxable income you put on your tax return, how much of that are you sharing with your involuntary business partner? That's going to be the IRS. That's going to be any state that you pay tax to, or, John, if you're so lucky to pay tax to a city or local government. So your MTRs, it's $100 of extra taxable income. How much do I get to keep? If your marginal tax rate's 30%, I get to keep 30. You pay your business partners 30. Now the question is this: we talk about this all the time. You have two choices. You pick your tax, or your business partners to pick your tax. You pick your tax by doing the proper tax planning. Tax planning starts with understanding your marginal tax rate, and in the teaching tax flow system, we use color-coded diagnoses to describe someone's situation. But for our purposes, we can use high marginal tax rate, kind of medium marginal tax rate, and lower marginal tax rate. And what we want to do is we want to recognize income as much as we can in those lower marginal tax rate years. And again, tax brackets are very confusing. I'm going to give you one very basic example, and then we're going to start talking about what items are considered when it comes to marginal tax rate versus tax bracket. Because remember something, there are a lot of phase outs. We've talked about phase outs before. Phase outs are wrinkles of the tax code that says, guess what? You get no tax on tips. But you know what? If you make too much money, you're on Santa's bad list, and now you have to pay tax on your tips. right? Because there's a phase out based on income. So let me give you an example, John. Let's assume you have someone that's our parents' age. Let's say they have a modest pension of $30,000 and they're married, filing jointly, and they have Social Security income. In that case, only a small part, or probably, let's say they have a pension of $20,000 and then they get $40,000 of Social Security. None of their Social Security is going to be taxable. However, if they have IRAs, and let's say they're over the required minimum distribution limit, or RMDs, they have to take money out of those IRAs. So let's say they're forced to take $30,000 out of their IRA. They're looking at the tax rate saying, well, honey, doesn't make any sense. We're in the 12% tax bracket. Why am I paying a 25% tax on my IRA distributions? That doesn't make any sense, because they don't understand marginal tax rate. Because their IRA contributions put them over a threshold, now either 50% or 85% of their Social Security is taxed. Okay, that's a perfect example of marginal tax rate. Now, conversely, if you're doing tax planning, for every dollar you can shield from reporting on your tax return, that's money that doesn't go to your business partners. But again, tax planning isn't about just getting deductions this year. It's about legally and ethically reducing the tax you pay in your lifetime. So that's the main difference between a marginal tax rate and a tax bracket. A tax bracket can be very, very deceiving.
And I love that you started with that too. Right out of the gate, you basically said it can be, like I say it is, can be very, very deceiving. So you might have a lot of people, and I think conditionally over time, right? We just understand, air quotes, that, oh, I'm in this tax bracket. Well, now we're basically saying, oh, here's my tax bracket. Who cares about your tax bracket? Get rid of the damn thing. Get it out of here. It doesn't matter. MTR is where it is. And to be totally honest, it took me a good probably 8 months or a year, even the first time I heard you say this, to really kind of understand it and be like, oh, well, that makes a lot of sense. So would it be true in saying you have tax bracket over here, you have MTR over here, your marginal tax rate? This one, the only way you can really control it is by not showing up to work or just, playing video games all day and not making income. This is where you have all the control, majority of it, as on the MTR side. Would
Sure.
that be a
I
fair
mean,
analysis?
yeah, I mean, look at the example of, I mean, the Social Security example is a good example, but look at the example of a student loan interest deduction, right? So to deduct your student loan interest, you have to be which the maximum amount of student loan interest deduction is $2,500, but to be able to deduct that, you have to be under certain income thresholds. So that's where it gets, that's where things get a little crazy. And yeah, so let's talk about the things. So to understand the difference between marginal tax rate and tax bracket, we have to look at all of the things that are different, right? Where can a tax bracket be deceiving? Now, tax brackets, they're not useless, but they're just deceiving. Does that make so? For instance, John, remember in a previous episode we talked about medical expenses, and medical expenses can, unless that's why there's a value to a health savings account. But out-of-pocket medical expenses are only deductible if you itemize and they exceed 7.5% of your income. Well, if your adjusted gross income goes up, then you're paying tax on that additional income. But what else is happening, John? You're losing deduction for medical expense, and now it's a double whammy.
Right. Right.
So
Right.
there's a lot of stuff that goes into it. So let's talk about what are the things we need to be aware of that affect your marginal tax rate that tax brackets can be deceiving on. Medical expenses, I already mentioned one. I mentioned student loan interest deduction because it phased out. The tuition and fees deduction gets phased out. IRA deduction can get phased out. The qualified business income deduction can get phased out based on your income. So that's pretty, passive activity losses. So we talk about rental property and rental activities being passive or non-passive. And if they're passive, if your income is over $100,000, then you start to lose the deduction. You start to lose the ability to deduct those losses in the current year, and they carry forward. We talked a lot about, and we have a ton of content. So if you're listening to this or watching this, I'm going to be a little feisty right now. Make sure you go to our YouTube channel, educate yourself, and look at the playlist that is all about OB3, One Big Beautiful Bill Act. We talk a lot about all those new deductions. We had a very popular podcast on Schedule 1A. That's the new IRS tax form for 2025. There's 4 new deductions on Schedule 1A that are going to greatly affect your marginal tax rate, but they're all phased out at different income levels. So no tax on tips. So let me make that example again, John. Let's say you're getting the full tip deduction right now. However, your income, you get an inheritance from an inherited IRA distribution, and now that shoots your income up, and you're looking at your tax bracket and saying, I'm in the 24% tax bracket. Why is my tax on this additional income 30%? Because marginal tax rate means you're paying that your income, you're increasing the amount of income that's taxed at that higher marginal tax or higher tax rate, and you're also losing deductions too. So that's where it gets tricky. So you're no tax on tips, you're no tax on overtime, your new car loan interest deduction, and the enhanced senior deduction. All those things are things that could make your marginal tax rate much, much different than your tax bracket. So your number one takeaway needs to be, my marginal tax rate is not my tax bracket.
And if somebody's listening to this for the first time, right, they're probably very excited. They're probably doing, we'll call it like the no tax dance or something. I don't know. Come up with something. I'm not going to start the wave because I'll be the only one doing it. Go back and listen to that content of the couple things that Chris just mentioned. Only, and I say this very highlighted, we should say, you heard no tax on tips. Go listen to it because it may not apply to you, even though you get tips. So a lot of those things, check them out. And Chris, maybe this is kind of interesting, right? We talked about kind of throwing out, and here I just want to throw another one. There we go, throw another note card. Throwing out the tax bracket thing. I just did a quick search, me being the marketer. Over 20 to 25,000 times a month estimated, somebody is searching online for tax bracket or what is my tax bracket. And almost 12,000 people are clicking through to that. So there's over 12,000 people a month that feel like they're educated because they know what their air quotes tax bracket is, right? So I wouldn't say it's dangerous, but it's misinformation in a sense, right? So in your profession, the private tax practice, you guys being tax pros, you really look at that MTR kind of as like the guiding light, right? Like if you don't know that, you don't know anything.
It's
right?
the only light. It's not even.
There you go.
Yeah, it's the most important thing when you're doing tax planning, and then liquidity, right? So if you want to control your marginal tax rate, you might want to consider one of some type of tax planning implementations. They could be behavioral, they could be tax advantage investments, they could be tax mitigation strategies. It just depends on your situation. Let's go through the other items. I had a real story where I had a client that was in the 80% marginal tax rate because they were getting the premium tax credit, meaning they were getting that subsidy from the government, and their income threshold went over that threshold, and had to pay back almost $20,000 of those premiums. Because their income was $30,000 too high.
Dude, that's painful.
So that's what I'm saying, marginal tax rate. So here are the differences. Here are the items that you have to be aware of that are different. The reason that your marginal tax rate is going to be different than your tax bracket. So your child tax credit, that's a phase out. Your additional child tax credit, your child independent care credit, your earned income tax credit. Now I'm going to talk about your lifetime learning credit and AOTC, American Opportunity Tax Credit. Those are going to be your educational credits. Retirement Savers Contribution Credit. We talked about that, I know, on the YouTube channel. Your premium tax credit, that has to do with when you're getting a subsidy based on your income. The adoption tax credit, and then there's a bunch of other hidden taxes. Remember, we did some content on hidden taxes also, right? Because there's the net investment income tax, there's additional Medicare tax, and then there's the really hidden tax. We talked about those hidden taxes with Social Security, IRMA, Medicare income related monthly adjustment amount. So if you are on Medicare and your income exceeds a certain amount, there's a 2-year look back where the government's going to say, John, your income was too high. So we're going to increase the amount you're paying for the same insurance that you have. That's a hidden tax. That's part of your marginal tax rate. So definitely talk to your tax professional about what the heck. I know this is probably the feistiest I've ever been on one of these podcasts.
No,
Very, very
LLC,
passionate
you
about
got hot. You were getting
What-
real spicy
the
when
heck?
LLCs. You survived.
is your marginal tax rate. And that drives everything. And for us in the teaching, and make sure so tired of these, we have to remember ideas are cheap and implementation is valuable. So what I mean by that is make sure your tax planning implementation matches your marginal tax rate need. If you're a low marginal tax rate, you shouldn't be putting money into a pre-tax IRA. You should probably do a Roth. If you're a high marginal tax rate, you should be doing high marginal tax rate implementations. So make sure that you're pairing your implementations with your situation.
And that is a great place to end this one at, right? So doing implementations on your own, again, coming at this from a different vantage point than Chris is, if anybody's listened to this, a couple things I got for you, then we'll wrap. Find somebody that you work with, that you trust, that understands your situation, but then also understands implementations. Chris, I think that line is one of the best you've ever said. We've been hearing it for years. If I ever got a tattoo with a quote from you, sir, I would say that, right? That ideas are cheap, implementations are valuable because it stretches across everything everybody does every day.
Right.
But like you said, only following through with those implementations that make sense, that pair with your MTR. That's the only way to do it. Otherwise, you're just throwing things out in a sense. So find that person, follow through with those implementations. Don't just shoot from the hip and say, oh, this is going to work. I'm going to do it. Go that route. Lean on people for it. The TTF community. We have our private Facebook group, defeatingtaxes.com. There's more people that are in that. I don't know exactly what the ratio is, but there's a lot of tax professionals in that. So don't think you're just going to ask a question and you're going to get advice from other people like yourself. You're going to get some professional information. Do that. And then subscribe to the YouTube channel. Do a search. I don't know if you guys knew that you can actually search within our channel on keyword, search for some stuff. And I promise it's in there. We've covered pretty much everything at this point. I don't think we're really introducing anything new. We're just clarifying, digging in deeper, and then introducing updates to things. That'd probably be fair to say, right, Chris, based on our content schedule?
Sure. And also remember with marginal tax rate, factor in your state and local tax. And your state and local tax might be based on different things. A lot of states exclude retirement income up to a certain level. Most of them exclude Social Security income up to a certain level. So again, your marginal tax rate has to be determined, and that's your overall tax, right? Not just your federal tax. So
Absolutely. And like we said, Chris deals with this stuff every single day and has been for a while. So you're hearing from somebody that knows exactly how impactful that is. And just again, we're going to throw the tax bracket out just because I like throwing sticky notes today for some apparent reason. I like trying to clog my vacuum when it's running around here later. But subscribe to the YouTube channel, as we mentioned. Get on Defeating Taxes. Ask us questions. Don't think you have nowhere to go. We are here. We'll get you the answers. We'll get you the place you need to go. Until then, we'll see you guys next week here on the Teaching Tax Flow podcast. Same day of the week, different date, completely different topic. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.